Coming into 2022, investors were actually in a position where equities were providing a higher level of yield than most parts of the fixed income market. That dynamic has massively shifted, and investors are essentially spoiled for choice within the fixed income market as rates have dramatically risen. That being said, we do think some selectivity is warranted as we head into 2023. Specifically, we're a bit more cautious on the high yield space and more constructive on what we would call blue chip issuers found in the investment grade and municipal space. With regards to high yield, these are issuers that are more prone to economic pressures, and as we head towards 2023, with the economy showing slower growth, relatively lower spending, and overall softening, this is an area where we think there is certainly room for additional spread increases. Corporate bonds trade at a spread to the risk-free rate, so that investors are coaxed into allocating capital based on the risks involved. But the spreads we see in the high yield space today are not in line with where we would expect them to be based on history. Where high yield bonds are priced at on average today, which is roughly a 13% discount to par value, history would expect that the spread would be close to 8%, whereas today in the market, it's actually 4.5% to 5%. So as we head towards 2023, we are cautious and would wait for a more attractive entry point as bond prices and yield move in inverse directions. With regards to the blue chip issuers, in the investment grade space, we have an opportunity to take advantage of yields that we really haven't seen sustainably since before the financial crisis. On average, investment grade bonds are yielding 5.3%. The 5-year average heading into the global financial crisis was 5.2%. So this is an environment we haven't been able to take advantage of at any point in the last 15 years. These issuers are more well-rounded, more well-capitalized, and ultimately able to weather the storm that comes with a softening economy a little bit better. And finally, in the municipal space, we see very low levels of defaults through recessions historically, credit ratings, very little impact through recessions for municipalities, and overall, just a strong level of tax collection throughout municipalities in the United States. Layer on the fact that these are tax-advantaged products, the tax equivalent yield that you receive is at a 15-year high. So combining a quality level of income with resilience, we think is a more prudent exercise in fixed income today, given the attractive yields available, without having to reach up the risk spectrum and allocate to high yield, where we will ultimately be able to receive more benefit likely later in 2023.